Ken Bernanke chairs his final policy meeting of 2009 today. And investors are waiting to hear what the Federal Reserve will say about the economy's recovery. So joining us now with his thoughts on the matter is James Shugg. He's a senior economist at Westpac Banking in London. Good morning, James. Thank you so much for joining us again.
Morning, Scarlet.
The Fed will almost certainly keep rates near zero once again. As for how much longer, will we continue to see the words "for an extended period" in the text?
I think we're going to see those words stay in there for quite some time to come. I suppose the issue for us is that at some point soon, the Fed is going to make a more formal distinction between measures to support the credit markets, the operation of financial markets, which do seem to be working in a more cohesive manner now, and a distinction between that and the measures, actually the low level of interest rates, which is supporting the economy. Because it's pretty clear that the economy, although it's growing okay at the moment, that is in response to all the fiscal stimulus that's been coming through. And that fiscal stimulus has involved a lot of pull forward of activity, particularly in housing and autos, from next year into this year. And so the Fed will still have some concern that the current positive numbers on the economy may not last.
Well, what kind of change in tone could the Fed strike in today's statement?
Well, I think it's clear that in the paragraph that discusses the economy and the labour market and so on, they will acknowledge that there has been, significantly better news on the economy up until now, but they will also have a note of caution about just how sustainable that's going to be. I mean, our view at Westpac is that there is a mismatch between the current, stimulus-driven growth story and that running out of steam around the middle of next year, and the ability of the economy actually to grow in a self-sustaining sense, which we don't think might really start until 2011. So if the Fed shares the concern about that risk, then I think they'll signal that extended period of low interest rates will be in place for quite some time.
That mismatch that you were referring to, that comes even after the spate of better than expected data from non-farm payrolls to wholesale inventories to industrial production. What are you seeing in terms of growth and perhaps a pullback?
But Scarlet, that's absolutely the point. Look, the economy's grown now for probably 6 months because of all the stimulus that's been coming through, and of course that's going to be feeding into less weak outcomes on the labour market. And of course the industrial production numbers have been supported by what's been happening, for example, in the auto sector. The housing stories looked a little bit stronger. We're going to get an update on that today, of course. That's been feeding into some, industrial production of construction materials. So, all of this is related to the stimulus. The point is, we are not yet convinced that there is a genuine self-sustaining recovery that's coming through. With households more inclined to save, with all the pull forward of activity from next year into this year, with the banking system still impaired, there's still plenty of big question marks, plenty of big risks accompanying the 2010 growth story. And given those risks, we think the Fed needs to keep policy easy for quite some time to come.
Sounds like an incomplete V-shaped recovery then. Thank you so much. We've been speaking with James Shugg, senior economist at Westpac Banking in London.